Good afternoon and welcome to Bulls, Bears, and the Bell, your ultimate guide to understanding the chaotic symphony of the financial markets. I'm excited to share a deep dive today into a truly extraordinary day, August 28th, 2025.
A fascinating day indeed.
Right. On the surface, if you just glanced at the headlines, the U.S. stock market seemed to sail through relatively calm waters,
Yeah.
closed with modest gains across the major indices.
Looked okay at first blush, yeah.
But, as we often discover here, the surface rarely tells the full story. Beneath those seemingly placid waters, a fierce and complex battle was raging.
Absolutely. Lots going on underneath.
This wasn't just any day. It was a day where the dazzling promise of cutting-edge AI breakthroughs collided head-on with the stark realities of escalating global trade wars, persistent inflationary pressures, and even an unprecedented political crisis, directly challenging the very independence of our Federal Reserve.
Quite the mix of forces. AI pulling one way, geopolitics and, well, domestic politics pulling completely different directions.
Exactly. So, for this deep dive, we've meticulously pulled apart the daily stock market post report from that day, along with a stack of critical news articles. Our mission for you, our listener, is to unpack this incredibly complex picture.
We want to reveal those hidden forces, the surprising facts, and, what these seemingly disparate events truly mean for investors and the broader economy.
We're going to explore how undeniable technology triumphs clashed with significant geopolitical tremors to create a day of, well, extreme divergence.
That's the perfect word for it, divergence.
So the big question we're tackling today is this. How can a market present such a resilient, even positive facade, while simultaneously grappling with such significant, contradictory, and frankly, potentially destabilizing pressures underneath? Let's truly unpack this.
That's a profound question, and it really gets to the heart of market interpretation, doesn't it? It highlights why looking beyond those headline numbers is not just helpful, but absolutely essential.
Couldn't agree more.
What's fascinating here is how those top-line figures, while, technically accurate, can be deeply misleading indicators of overall market health. August 28th stands out as a textbook example of why our deep dive approach, peeling back the layers, is so critical.
I couldn't agree more. Let's start right there with those headline numbers, because they certainly painted a picture that might have lulled many into a false sense of security, didn't they?
They did. Easy to just see the green and move on.
Right. The major U.S. indices, despite everything bubbling beneath, somehow managed to edge into positive territory by the close. The S&P 500, that broad barometer, ticked up just slightly to 6,481.40. That was a gain of, 15.46 points, or a modest 0.24%?
Barely moved, really, in percentage terms.
The Dow Jones Industrial Average finished at 45,565.23, adding about 147 points, so a bit better, 0.32% rise.
Okay.
And even the tech-centric NASDAQ composite, often more volatile, managed to add 45.87 points, closing at 21,590.14, which is a 0.21% gain.
Indeed. Taken purely at face value, those numbers might suggest a degree of stability, maybe even quiet confidence in the market.
Might suggest, yeah.
However, if we connect this to the bigger picture, these aggregate figures alone tell an incredibly incomplete story. They project an image of market resilience, yes, but that resilience was exceptionally fragile, like a thin layer of ice over turbulent waters.
Great analogy.
The true narrative of August 28th lies significantly beneath these averages in the movements of individual companies.
And this is where it gets really interesting, because those positive finishes were absolutely not indicative of broad market health. This is a classic case of what we call lack of breadth.
Lack of breadth, exactly.
When we talk about lack of breadth, imagine a rising tide. Usually a healthy market means the tide lifts almost all boats, right? Or at least a significant majority.
You want to see broad participation.
But on August 28th, it was more like a few luxury yachts were soaring, while the vast majority of smaller vessels were actually struggling. We found that a staggering nearly 58% of the individual companies within the S&P 500 actually ended the day in negative territory.
Almost 6 out of 10 companies losing ground. That's not a healthy sign, even with the index up.
It's a huge disparity.
Precisely. This statistic indicates that the entire market advance was effectively carried by an extremely small minority of mega capitalization technology and communication services companies.
Just the big guys pulling all the weight.
You saw significant gains from names like Broadcom, which was up a robust 3.1%, Oracle climbing 1.9%, and Alphabet, Google's parent, adding 2.1%.
Those are the heavy hitters.
Right. And this dynamic highlights a very significant vulnerability. It's like building a towering skyscraper on just a few support pillars rather than an evenly distributed foundation.
That's a powerful analogy.
Yeah.
It's almost like a few superstar players carrying an entire team, isn't it?
It is. If one of those key players stumbles, maybe has a bad earnings report or regulatory trouble.
The whole team is in trouble. This narrow rally means that if anything were to negatively impact these few market leaders, the entire market could see a disproportionately large and sudden downturn.
Yeah, a magnification effect.
It makes the overall market's apparent strength exceptionally fragile, built on a very concentrated foundation.
That's a critical observation. This kind of narrow leadership inherently increases systemic risk. Now, let's maybe consider some of the counterintuitive market signals that emerged on this day. They truly make you wonder what the market was thinking.
Or ignoring.
Or actively choosing to ignore exactly in its single-minded focus.
Right. For instance, the SIBO Volatility Index, the VIX, the market's fear gauge,
Yeah.
it actually fell 4.31% to 14.23.
Fail. On a day with major tariff news and a crisis at the Fed.
My gut tells me that with major tariff announcements creating global economic uncertainty and a political crisis brewing at the Fed, you typically expect the VIX to rise significantly.
Absolutely. Signaling heightened investor nervousness, anticipation of bigger price swings.
The VIX measures expected future volatility, so a drop usually means investors are feeling less fearful. What does this counterintuitive drop suggest in such a, tumultuous environment? Was the market just complacent?
Or, as you said, fixated on something else entirely, dismissing these very real risks. It's perplexing. It suggests a peculiar form of market complacency or maybe a singular powerful focus that just overrode all other concerns, effectively suppressing that fear response.
Okay, so maybe complacency, maybe tunnel vision. What about bonds?
Similarly, the 10-year Treasury note yield, often seen as a barometer for long-term economic outlook, was largely stable at 4.21%.
Stable, not dropping.
No. Given the geopolitical and domestic economic uncertainty we'll discuss further, one might expect a classic flight to safety. Investors pour into U.S. government bonds, pushing prices up and yields down.
Right, seeking safety.
The fact that yields remain stable indicates that fixed income investors were also singularly focused. Not on safety from these immediate crises, but on a specific future event.
So if neither equity investors, reflected in the VIX, nor bond investors with stable treasury yields were reacting with fear or seeking safety, what were they so singularly focused on? It sounds like one dominant narrative was just anchoring everything.
There was, and it was a powerful, almost unwavering belief in future monetary easing by the Federal Reserve. The market was clearly anchored by the prospect of imminent interest rate cuts.
The Fed pivot hope.
Exactly. On August 28th, traders were assigning a remarkable 85.3% chance of a quarter-point rate cut at the Fed's upcoming September meeting.
Wow, 85%. That's high conviction.
It is, and this reliance on the Federal Reserve to act as an infallible backstop creates a highly precarious situation. It suggests the market has become overly dependent on a specific policy outcome.
So the market has developed this deep conviction that the Fed will cut rates soon. And the conviction is so strong, it's essentially causing investors to, overlook or downplay other serious fundamental risks we're seeing unfold.
That's precisely the risk. This raises an important question for you, our listener, to consider. Is the market actively underpricing real, tangible risks due to its conviction in the Fed's dovish path?
Because if the Fed doesn't deliver,
If the central bank, for whatever reason, doesn't meet these strong dovish expectations, if they delay or even hint at a different path, the market could be forced to suddenly and violently reprice all those ignored risks.
which would mean
A severe and potentially disorderly market reaction. It's betting heavily on one specific outcome, and as we know, such bets, when they don't pan out, can lead to considerable and abrupt losses.
that's a truly powerful and somewhat unnerving point. It perfectly illustrates how much weight investors are placing on the Fed's potential actions, almost to the exclusion of other fundamental economic and geopolitical realities.
Definitely a key takeaway from the day's action.
Now, let's pivot and transition into the three defining narratives that truly shaped this incredibly complex day, pulling the market in radically different, often contradictory directions. These are the major forces creating that deep divergence we discussed.
Indeed, these three forces, a significant trade conflict, unexpectedly robust domestic economic data, and an unprecedented political challenge to the Fed's independence, weren't just isolated events, they interwove and clashed throughout the day.
Creating a real headache for investors trying to get a clear read.
Exactly. Made it incredibly difficult to get a unified sense of direction for the economy or the market. It was a day demanding a nuanced understanding of conflicting signals.
Let's start with the one that sent shockwaves across the globe, the escalating tariff situation between the U.S. and India. On August 28th, markets fully digested the Trump administration's sweeping implementation of a 50% tariff on a wide range of Indian goods.
Yeah, that 50% number really stood out. It was a combination, right? A 25% tax plus an additional 25% penalty.
Right. It had officially taken effect August 27th, but the full impact really hit trading floors the next day.
The official rationale behind the significant punitive measure was to penalize India for its continued and substantial purchases of Russian oil.
Okay, that was the stated reason.
That was the stated reason. But this move immediately introduced a fresh, potent layer of geopolitical risk into the global economy. It was undeniably a primary driver of pessimism, particularly across Asia and emerging markets, but with clear reverberations back here in the U.S. too.
And the impact on India itself was severe, wasn't it? Our sources paint a pretty grim picture.
Absolutely. Indian equities, understandably, were hit particularly hard. Domestic indices saw steep losses, reflecting widespread investor concern. Market sentiment across India was described as, well, bearish.
Not surprising.
Companies and investors were grappling with the profound implications for their export-oriented economy. The Indian government quickly estimated that a staggering $48.2 billion worth of its exports would be impacted by these new duties.
$48 billion. That's an enormous sum, a significant chunk of their trade with the U.S.
It is. And these tariffs weren't just a broad brush approach. They were really targeted at specific, sensitive sectors within the Indian economy, weren't they?
They were, very strategically so.
Yeah.
The levies were explicitly targeted at India's most labor-intensive sectors, those that employ vast numbers of people, crucial for their economic development, and, frankly, social stability.
Like what, specifically?
We're talking about textiles and apparel. A massive industry in India, gems and jewelry, a traditional export powerhouse, leather goods, specific seafood like shrimp, hand-knotted carpets, and various types of furniture.
So hitting them where it hurts in terms of jobs?
Exactly. This focused approach immediately places Indian exporters at a severe competitive disadvantage against regional rivals like Vietnam, Bangladesh, Indonesia.
Who face much lower or maybe even zero tariffs for similar goods entering the U.S.
Right. It's been widely described by economists as a wake-up call for India's trade policy. And the political fallout was immediate, too. Negotiations for a bilateral trade agreement, postponed indefinitely.
Wow. So significant diplomatic strain on top of the economic hit.
So it's not just an economic hit for India, but a diplomatic setback and potentially a major restructuring of global supply chains. But I remember hearing there were some crucial exemptions, right? Not everything from India got hit with this heavy 50% tariff.
That's a very important nuance, yeah. Some strategic relief did come from exemptions for pharmaceuticals, which is critically important given India's role as, the world's pharmacy.
A vital supplier of affordable generic drugs to the U.S. healthcare system.
Exactly. And electronics were also largely exempted, including, notably, Apple iPhones manufactured in India for export.
Interesting. So avoiding areas vital to U.S. consumers or where major U.S. companies have skin in the game?
Seems like some strategic calculation there, yes. In response, Indian officials were quick to state that communication channels with the U.S. remain open. But they're also beginning domestic reforms, tax adjustments, financial incentives for exporters trying to cushion the blow.
Preparing for the long haul, sounds like.
Suggests they are preparing for a protracted period of trade tension, yes.
So on one hand, we have this global trade conflict causing widespread pessimism, economic strain for a major nation, uncertainty for supply chains, a significant headwind.
Definitely a drag.
But then, almost in a schizophrenic twist, domestically, the economic picture was actually surprisingly robust. Which brings us to our next defining narrative. It was almost as if the U.S. economy was just shrugging off these global concerns, at least for a moment.
Exactly, a stark contrast indeed. In a sharp pivot from the negative global trade news, fresh data released by the U.S. Commerce Department painted a picture of unexpectedly robust domestic economic health. This presented a very different signal for the Fed and the market.
Right. The second quarter 2025 gross domestic product, GDP, was actually revised upward to a robust 3.3% annual growth rate.
3.3%. That's a pretty significant jump from the initial estimate of 3.0%, isn't it?
It is. And remember, this followed a 0.5% economic contraction in the first quarter. So a 3.3% rebound really signals a strong turnaround in economic activity.
It absolutely does. This strong upward revision was primarily driven by stronger than initially reported figures for both consumer spending and private investment.
So people were still spending, businesses still invested.
Signaling underlying confidence, yeah. Additionally, a substantial technical boost to that headline growth figure came from a sharp decline in imports during the quarter.
Ah, the GDP calculation quirk. Imports are subtracted.
Right, so fewer imports actually boosts the headline number, gives it an extra kick. So while domestic demand was strong, a reduction in foreign goods entering the market also contributed.
And it wasn't just GDP showing strength, was it? The labor market also seemed to be signaling surprising resilience. A tight environment still.
Precisely. Complementing the strong GDP report, the latest labor market data also signaled persistent economic strength. The Labor Department reported that initial applications for unemployment benefits fell by 5,000 to 226,000 last week.
Still very low historically.
Very low. A clear indicator that employers are holding on to their workers in what remains a remarkably tight labor market. Finding qualified employees is still a challenge.
So together, this data portrays a surprisingly resilient U.S. economy, which sounds great.
Sounds unequivocally positive on the surface, yes. But for the Federal Reserve and for market expectations, it creates a very significant policy complication.
That's the policy complication we absolutely need to talk about, because strong economic growth and persistently low unemployment typically fuel inflationary pressures.
Right, the exact opposite of what you'd want to see if you're hoping for rate cuts.
This directly challenges the market's entrenched expectation for imminent interest rate cuts from the Fed, which we just discussed as the dominant narrative. In essence, this robust economic data presents a fundamental argument against easing monetary policy, doesn't it?
Unequivocally, it puts the Fed in a real bind.
How so, specifically with their mandate?
Well, the Federal Reserve operates under a dual mandate: maximum employment and price stability. Strong growth and a tight labor market suggest the economy might be running hot,
Risking inflation.
which would typically warrant a more restrictive monetary stance, meaning maintaining higher interest rates to prevent inflation from accelerating or becoming entrenched. So this data directly conflicts with the market's fervent hopes for a dovish Fed, creates deep tension between economic reality and investor expectation.
And speaking of the Federal Reserve,
Oh boy.
a political firestorm was brewing that day, adding yet another unprecedented and potentially destabilizing layer of complexity.
Yeah, this is truly a wild story, something you rarely, if ever, see. An unprecedented challenge to the very principle of central bank independence.
Tell us about it. Federal Reserve Governor Lisa Cook.
She filed a lawsuit against President Donald Trump, challenging what she unequivocally called his unprecedented and illegal attempt to remove her from the Fed's powerful board of governors.
Not just a political spat, this strikes right at the heart of how our financial system is designed to operate, doesn't it?
It is truly an extraordinary development. The president's stated cause for the attempted dismissal was an unconfirmed allegation concerning a mortgage application Cook made before her Senate confirmation.
Okay, that's the official reason, but the lawsuit says
The lawsuit contends this is merely a pretextual reason, a convenient cover. The true objective, according to the suit, is far more significant: to seize control of a crucial board seat, to install a nominee more compliant with the administration's political agenda.
specifically the desire for lower interest rates.
Exactly. Lower rates, regardless of economic conditions. This is a direct challenge to the traditional separation between fiscal political power and independent monetary policy.
So it's not really about the mortgage application, but about power, control, influencing monetary policy. What's the broader significance of something like this? This feels like a huge, potentially destabilizing deal.
What's fascinating and deeply concerning here is how such a political event can directly impact fundamental economic confidence, even global financial stability.
How so?
This direct confrontation represents a grave challenge to the long-standing tradition of Federal Reserve independence. That principle has been a bulwark of U.S. economic stability and credibility for decades.
The idea that the Fed makes decisions based on economics, not politics.
Precisely. The politicization of monetary policy, if it takes root, could erode investor trust, unmoor long-term inflation expectations, destabilize the very foundations of how markets operate, both here and globally. We even saw the US dollar weaken that day, partly due to these heightened concerns about the integrity of its central bank.
Wow, so the implications stretch far beyond just one rate hike or cut. They touch upon the very trust in our financial guardianship.
Absolutely.
So how is this legal battle expected to play out? Is there a quick resolution in sight, or are we looking at a protracted fight?
Well, the legal battle is set to begin with an initial hearing in federal court. But given the constitutional implications, the high stakes involved, it's widely expected to be appealed,
All the way up.
potentially reaching the Supreme Court. Both the White House and the Fed have publicly committed to abiding by the final court decisions, which provides some assurance of an eventual resolution. But the interim period of uncertainty and the precedent this sets are significant. It's a legal drama with profound economic consequences.
All these powerful conflicting forces, trade wars, robust domestic growth, this unprecedented political pressure on the Fed converge to create what we're calling the Fed's policy paradox. How does the Fed navigate this? It seems like they're being pulled in so many irreconcilable directions.
It's an incredibly difficult position. They face profoundly contradictory signals. On one hand, strong GDP and labor data firmly suggest maintaining restrictive policy to fight persistent inflation.
Hold rates high, maybe even hike.
On the other hand, the new tariffs on India act as what economists call a stagflationary shock. They're inflationary, right? Raising costs for U.S. consumers and businesses. But they also risk dampening future economic growth by disrupting trade and supply chains.
So higher prices and slower growth. Nasty combo.
Exactly. Such a shock could, paradoxically, argue for some degree of monetary easing to support growth.
So data says tighten, tariffs say maybe ease.
And then, layered on top of these already conflicting economic signals is the immense, unprecedented political pressure from the White House wanting lower rates.
So effectively, any decision the Fed makes now, whether to cut, hold, or even raise rates, will inevitably be viewed through a highly political lens, risking damage to its credibility and independence.
Exactly. This convergence sets the stage for a period of exceptionally heightened uncertainty around U.S. monetary policy. Whatever path they choose, it will be scrutinized intensely, not just for its economic merits, but for its perceived political motivations. Makes their job extraordinarily difficult.
This isn't just about managing the economy. It's about preserving the institution itself.
A critical point.
This truly feels like a crossroads. Now let's bring this down to a more granular level and look at individual companies. Our next segment, Spotlight on Market Movers, really illustrates this extreme divergence in action. The market on August 28th truly had a split personality.
It did. We saw the euphoria of AI-driven tech triumphs against the harsh realities faced by other sectors grappling with entirely different forces.
It's a perfect microcosm of the day's underlying tensions.
This individual stock performance perfectly encapsulates that broader, fragmented narrative. You had segments soaring on genuine tech breakthroughs, robust earnings, real demand, while other companies were getting hammered by forces like commodity inflation or, the unwinding of speculative excess.
Let's start with the AI juggernauts. The companies that truly defied gravity seemed immune. Pure Storage, ticker PSTG, saw its shares skyrocket by an astounding 30.40% in a single day.
30%. That's an incredible surge for a company of its size.
What exactly drove that kind of explosive move?
The rally was ignited by a truly stellar second quarter financial report. Just blew past Wall Street's already high forecasts.
What are the numbers?
Pure Storage. They provide enterprise data flash storage solutions, right? They announced revenue of $861 million, significantly ahead of the $846.3 million consensus. More impressively, non-GAAP profit of $0.43 per share, handily beating the expected 39 cents.
On top and bottom line.
Right. And this strong performance led management to confidently raise their full-year revenue outlook to a range of $3.60 to $3.63 billion, plus a very strong Q3 forecast that also beat expectations.
Okay, so strong numbers, raised guidance, always a recipe for good stock performance. But there was a game changer in there, wasn't there? A specific massive deal that really caught the market's attention, highlighted their position in the AI boom.
Absolutely. The single most significant catalyst, the one that truly excited investors, was the revelation of a major flash storage partnership with Meta Platforms.
Meta, Facebook's parent. One of the hyperscale leaders in the AI race.
Exactly. Pure Storage disclosed it's on track to ship an enormous 1 to 2 exabytes of storage to Meta by the end of the fiscal year.
An exabit. That's a billion gigabytes.
Billion gigabytes.
Wow.
Massive scale. And this isn't just big in scale, it's projected to be highly profitable. Management projected gross margins on that Meta revenue to exceed a remarkable 90%.
Wow, over 90% gross margins on that kind of volume.
Yeah.
That is genuinely incredible. Must be a testament to their tech, their competitive edge in this critical AI infrastructure space.
It is. This partnership provides a direct, tangible, and highly profitable link between Pure Storage's tech and the massive capital expenditure cycle by hyperscalers, like Meta building out AI capabilities.
Clear signal they're cashing in on the AI revolution.
Directly, validating their tech and market position. Unsurprisingly, multiple Wall Street analysts promptly raised their price targets, some by significant amounts.
Makes perfect sense. And Pure Storage wasn't alone in this AI-fueled ascent. Snowflake, ticker SNOW, the cloud data platform specialist, also saw its shares climb impressively by 20.71%.
Another big winner, Snowflake, key player in data warehousing analytics. They delivered a classic beat-and-raise quarter that thrilled investors, echoed that AI excitement.
What do their numbers look like?
For its second fiscal quarter, Snowflake reported revenue of $1.1 billion, a robust 32% year-over-year increase. Adjusted earnings per share of 0.35 cents. Both figures comfortably exceeded consensus estimates. Strong operational execution.
So, similar to Pure Storage, strong earnings and revenue.
Sure.
But what about their underlying business metrics, particularly for a subscription-based cloud service like them? Were they equally robust, indicative of long-term health?
They certainly were. The company's remaining performance obligation, or RPO.
That's future contracted revenue, right? Key indicator for cloud businesses.
Exactly. It grew an impressive 33% to $6.9 billion. Think of RPO as their contractual backlog revenue locked in but not yet recognized. For a subscription service, this is gold. A 33% increase to nearly $7 billion is a powerful vote of confidence from customers. Signals long-term commitment, predictable future income.
And customer growth.
Also strong. Client spending over $1 million annually grew by 30%, and its net revenue retention rate held strong at 125%.
Meaning existing customers are spending 25% more.
On average, yes, significantly increasing their spending on the platform. Management explicitly attributed the strength and the raised guidance to surging demand for its data analytics services, as enterprises everywhere prioritize and accelerate AI investments.
They're a foundational layer for companies trying to leverage AI.
Precisely.
So these two companies really showcase how powerful that AI narrative is right now, translating directly into incredible growth, market enthusiasm. But while these AI-centric tech stocks soared, other companies faced a very, very different reality.
Yeah, this brings us to the fallen.
Companies grappling with profitability crises, experiencing brutal post-earnings collapses, really highlights that market divergence.
This is precisely where the market's divided personality becomes most evident. The euphoria in tech just didn't translate elsewhere, and the broader market was utterly unforgiving of perceived weaknesses or unexpected challenges.
Shows that even in an AI-driven bull market, underlying economic realities can't be ignored forever.
Exactly right.
Let's talk about Hormel Foods, ticker HRL. Plunged an astonishing 11.99%. Our sources note this was reportedly the steepest one-day loss in the company's trading history.
A huge drop for a consumer staples giant like Hormel. Known for stability, brands like Spam, Jennie-O, Planters.
So what happened to a company like that to cause such a shockwave?
This dramatic sell-off was triggered by a third-quarter earnings report that revealed a severe, rapidly escalating profitability crisis. And here's the crucial disconnect. Hormel's revenue, $3.03 billion, actually beat analyst expectations.
So sales were good. People still buying Spam.
Apparently so. Consumer demand was still there. But its adjusted earnings of 35 cents per share fell significantly short of the $1.41 consensus forecast.
Healthy top-line sales, collapsing bottom-line profits. That's the warning signal.
That was the central issue for investors, yes.
So sales good, profits bad. Why that severe a hit to profitability? You'd expect Hormel to have some pricing power, efficient supply chains.
Hormel's management was forced to slash its full-year profit outlook. They cited a sudden and major run-up in commodity input costs that worsened significantly beyond our projection.
What kind of cost?
They detailed extreme, unanticipated price inflation in key inputs, noting, for example, the price of pork belly surged an astonishing 30% in a very short period. Beef prices near all-time highs.
Wow, so the cost of making their products just exploded.
Exactly. This is a powerful, real-time case study in margin compression. Vividly shows how quickly inflationary pressures in the real economy, particularly raw materials, can erode corporate profitability even when consumer demand stays healthy.
Like the cost of making your favorite sandwich just spiraled for the producer, eating directly into their bottom line.
Perfectly put.
That's a truly stark example. And if we connect this to the bigger picture, it offers a cautionary preview of how those new U.S. India tariffs could impact other sectors. If companies importing goods face similar sudden cost increases.
We could see similar margin squeezes spreading through the economy. It almost feels like a canary in the coal mine, doesn't it?
It absolutely does. Hormel's experience serves as a clear, immediate warning, highlights how quickly external shocks, commodity prices, new tariffs can translate into profitability issues for companies in the physical economy.
Raises the critical question, is this isolated to Hormel, or an early indicator of broader stagflationary pressures? Rising costs, maybe slowing growth, impacting other consumer-facing industries soon.
Something to definitely watch. Another company that struggled dramatically was Accelerant Holdings, ticker ARX. Recently public insurance tech company. Stock collapsed by a staggering 24.65% in one day.
Brutal welcome to the public markets for a recent IPO.
What was behind that precipitous drop?
This dramatic sell-off came after their very first quarterly report since the IPO, and it presented a bit of a paradox that the market, in its current nervous state, just couldn't tolerate.
A paradox, how so?
Accelerant actually beat Wall Street's earnings per share estimates, reported GAAP EPS of Surgeon's 14 cents versus a projection of Surgeon 13 cents.
So they made more money per share than expected. That sounds good.
It does, but they missed on the top line. Revenue of $219.1 million fell short of the $227.9 million consensus estimate.
Beat on earnings, missed on sales. For a high-growth, newly listed company, I imagine that revenue miss is often viewed as far more serious.
You've hit on a critical distinction. For high-growth, newly listed companies, the market places immense value on top-line revenue growth, often prioritizes it over immediate profitability.
So a revenue miss signals maybe their growth trajectory is slowing.
Yeah.
Challenges the whole investment thesis.
Exactly. The market's nervousness was further compounded because the company decided not to provide explicit forward-looking financial guidance in its earnings release.
No guidance. That always makes investors nervous.
Intensified the uncertainty. It really highlights the intense scrutiny and sky-high expectations placed on recent IPOs, especially in a market grappling with conflicting signals, even though they had some strong operational metrics like good growth in premium written and strong revenue retention.
The revenue miss and lack of guidance were enough to trigger that severe correction.
Precisely.
And then we have Newegg Commerce, ticker NEDG. The online electronics retailer dropped 18.27% that day. This one feels different, though. Didn't seem tied to any specific negative company news or earnings report.
It wasn't tied to immediate news, no. And that's precisely why it's a classic example of what happens when a meme stock rally reaches its unsustainable peak.
The meme stock factor.
Newegg stock had been on a massive, almost parabolic speculative run, increased by nearly 3,400% since early May.
3,400%.
Driven by?
Almost entirely by retail trader enthusiasm, social media hype, not by any fundamental improvements in the company's business or financial health.
So this precipitous drop is best understood as aggressive profit-taking then. A kind of painful, inevitable reversion to the mean after an absolutely unsustainable rally. That's precisely it. A significant unwind of speculative positions. Aggressive profit-taking by early entrants. Analysts have repeatedly pointed out Newegg's valuation had become completely disconnected from its financial reality.
Which includes?
Declining sales, persistent EBITDA losses. There's virtually no formal Wall Street analyst coverage. A red flag itself. And even recent insider buying had been viewed with suspicion by some institutional investors. Maybe a prelude to large insider sales. Fueled skepticism.
So a stark reminder of the immense risks of investing based purely on social media hype rather than tangible business results.
The market eventually will always reassert fundamental principles, often with brutal force for those caught on the wrong side.
Wow. So we've seen this incredible push and pull throughout the market. On August 28th, soaring AI innovation juxtaposed against deep valleys of commodity inflation, trade wars, speculative unwinding. Now let's wrap this up. Concluding analysis, look at what this all means for you, what to monitor moving forward. So what does this all truly mean for us? The market's complex performance on August 28, 2025 unequivocally reveals an economy, a financial system, at a precarious crossroads.
Indeed. A state of fragile equilibrium persists, but it's an equilibrium built on very narrow foundations, as we discussed.
Right. On one side, immense capital expenditure in AI infrastructure, creating this powerful tailwind for a select group of tech companies.
That AI momentum, shown by Pure Storage and Snowflake's gains, is currently providing just enough lift to keep broad market indices afloat, masking underlying tensions.
But this narrow leadership, as we discussed extensively, is clearly masking growing and significant risks percolating through the real economy, isn't it? Feels like we're not seeing the full picture just looking at the S&P 500.
It absolutely is masking risks. The new U.S.-India tariffs represent a significant new inflationary and growth-damping force, injecting uncertainty, raising costs.
And the roll showed us how that can play out.
Exactly. The potential macroeconomic impact of these tariffs was vividly modeled in real time by Hormel's microeconomic collapse, a stark illustration of how quickly rising input costs can crush corporate margins. Posing the agent question, is Hormel isolated, or the canary in the coal mine for broader stagflationary pressures?
Rising prices, slowing growth impacting other sectors.
A real risk.
So with all these conflicting signals,
Right.
the divergence, these immense pressures, what's the market's immediate focus going forward? What will investors be watching most closely?
The market's immediate attention will now pivot sharply to the release of the upcoming Personal Consumption Expenditures Price Index, the PCE index.
Not just another inflation metric, the Fed's preferred measure.
Exactly. Given its comprehensive scope, its ability to capture shifts in consumer spending habits, this data point will be a critical catalyst for near-term market direction.
Okay, so what are the potential outcomes? What if PCE comes in cool or in line?
If PCE is in line, or even better, cooler than expected, it would largely validate the market's current dovish expectations, likely fueling a broader equity rally by reinforcing the probability of that September rate cut.
Okay, that's the bullish case. But what if it goes the other way? What if PCE comes in hotter than expected, indicating inflation is more persistent than the Fed hopes?
If PCE comes in hotter, it would intensely complicate the Fed's already precarious policy paradox. This would force a painful, rapid reassessment of the likelihood of imminent easing, potentially shattering market expectations. A significant, sharp market sell-off. The market's conviction in the Fed's dovish path is so strong that any deviation could be met with a dramatic, disorderly reaction, as investors suddenly have to price in all those previously ignored risks.
A major potential inflection point then. So for you, our listener, what are the 3 key themes you should be monitoring most closely as we move forward, building on everything we've discussed today?
Okay, 3 key themes. First, pay very close attention to the margin erosion versus AI expansion dynamic.
The push and pull we saw?
Exactly, the central tension. Margin compressing forces of inflation and tariffs pushing costs up for many companies versus the margin expanding potential of the AI revolution creating enormous value for others. Watch for further signs of profitability pressure in non-tech sectors, like Hormel showed us.
Is the pain spreading, basically?
Right. Is it broad and deepening or somewhat contained? That's theme 1.
Okay, crucial balancing act. What's the second theme?
The second is the durability of the AI rally. The critical question is, can the powerful, almost singular AI narrative continue to single-handedly support the broader market?
Against the gravitational pull of slowing global growth, trade conflicts, domestic policy uncertainty?
Yes. The performance of bellwether stocks like NVIDIA, for example, will be a key barometer. If AI's momentum falters or if its economic benefits don't broaden out, the overall market leadership narrows even further, increasing its fragility.
Can AI keep carrying the team? Got it. And finally, what's the third key theme, tying into the geopolitical and political shifts?
The third is the geopolitical risk premium. The market currently appears to be significantly underpricing the risks associated with both the U.S.-India trade conflict and the unprecedented political pressure on the Fed's independence.
The market's just ignoring those risks for now.
Largely, it seems. Any further escalation on these fronts, new tariffs, retaliation from India, significant developments in the Cook lawsuit, could lead to a rapid, disorderly repricing of risk across assets.
Meaning?
A sharp spike in market volatility as investors are forced to acknowledge and react to tail risks they've largely been ignoring.
Well, we've certainly seen a day where the market tried to pull itself higher on the back of incredible tech innovation and that powerful AI narrative, while simultaneously grappling with deeply unsettling forces on the global and political stage. It's a vivid, almost jarring reminder
that the market is a complex, living ecosystem, countless interconnected threads, and the headline numbers often hide the true, tumultuous story beneath.
It absolutely emphasizes the need for continuous vigilance, a critical eye, and a nuanced understanding of these often contradictory underlying forces.
The market is never a monolith, and August 28th illustrated that with undeniable clarity.
As you consider this deep dive, think about this. In an increasingly interconnected and rapidly evolving world, how do these seemingly disparate events, from targeted tariffs on textiles to groundbreaking AI breakthroughs to unprecedented political lawsuits challenging central bank autonomy, how do they ultimately converge to redefine what we consider fundamental market risk and opportunity? What stands out to you about how quickly fortunes can shift, not just for individual companies, but for entire economies in this incredibly dynamic environment?
A lot to chew on there.
Indeed. Thank you for joining us on this deep dive into the market's tumultuous day on August 28, 2025. We hope this has given you a clearer, more nuanced understanding of the forces shaping our world and equipped you with critical insights for navigating its complexities. Until next time, keep digging, keep learning.